Welcome back to The Next Big Risk. I'm Sonali Basak. As co-CIO at Sixth Street Partners, Josh Easterly knows how to manage risks. But he fears that the next generation and those that move from investment banking to private credit might not understand the precariousness of private credit.
On private credit, to me, the thing that worries me the most is that an asset class has grown, and there's a good reason why it's grown, that we don't deliver on the promise because we haven't developed talent, and talent hasn't caught up with the asset class.
This is an asset class that at the end of last year was north of $1.7 trillion. Yeah. It's an asset class that many investors believe is the future finance in many ways. What is the promise? Yeah,
I think the promise is durability of returns and a narrow bound of returns. But as the asset class has grown, it requires additional talent to actually provide those returns to investors. If you take a step back, why people like the asset class? People like the asset class because it's a better model than traditional banking. It has match funding, there's not an asset liability mismatch, and the returns are durable. The challenge is that it takes an investor mindset to actually be able to deliver those returns. And people typically think about the business model having either one of two constraints, which is one constraint is capital, and the other constraint is opportunities. That's actually not the constraint. Capital is not the constraint, and opportunities is not the constraint. The real constraint is actually people to deliver the returns.
Is another way of saying this, too, is that because returns were durable in the past, it doesn't mean that they necessarily will be durable in the future, depending on who's running the money.
In the old model, where it was a banking model, that model was a model where it was a distribution model. It was in the moving business. And so you had the difference between where assets were created, originated, and ultimately sold to asset managers. In the private credit model, that model has collapsed, where it's not only an origination business, but it's actually more importantly a storage business. And so you have to have a skill set that's different than the traditional banking model, which was that skill set was actually very narrow. Now the skill set needs to be much broader and much more focused on risk management.
So what happens then if you have banking talent moving over to private credit? What might they not understand?
The best way to think about it is a banker thinks about a asset return in the expected return. What is the average outcome? An investor thinks about it as what's the distribution of outcomes. So we can actually think about the average being the same, but what really matters to investor experience and to the performance of that asset class is what's the actual distribution.
A smart investor once told me that when it comes to credit investors, the biggest secret is not to lose money. Do you think that what will happen is if you have this inexperienced group of investors coming into these really fast-growing industries, private credit and all of the types of private credit around it, that they may not know the risks they're underwriting?
Private credit's about loss avoidance. I think the easiest way to frame it is, in private equity, for example, the nature of private equity, you only have to be right about 70% of the time. If you make 3 times your money on 70% of your investments and lose all your capital on the other 30, it's a 2 times fund, and it's probably a top quartile fund. In public equities, you got to be right a little over 50% of the time, in long-short public equities. In venture, you got to be right about 20% of the time, because your winners pay for your losers. Because of the nature of credit, you got to be right about 99% of the time. That takes a really different mentality and takes a group and culture who really is focused on tension around decision-making and tension around not losing money. And so that's what keeps me up at night.
Are you afraid now that there are already people who have let standards get too loose in the industry?
I'm afraid that the asset class has grown where there is capital flowing to the lowest common denominator, where the cultures and the talent is not prepared to deliver on the asset class returns. I want the asset class to do well, because that will do well for everybody. And so I want to make sure that there's durability of returns and we deliver on those promises for our allocators and investors.
Do you think a lot of people who come into private credit for the first time, Do you think that they maybe misunderstand a few things about the industry, given that it is private and they don't see the marks every day? Do they think that that means that things don't move around much in price, that they are inherently safer?
Don't get me down the marking rabbit hole. I actually think just because an asset class doesn't trade doesn't mean the value of that asset class doesn't actually move. And so with private credit, the biggest challenge is your ability to create liquidity when you make a mistake is more narrow because you're the owner of that asset, and likely maybe the sole owner of the asset or one of a few people of the owner of the asset. So there's not a lot of people following that asset that can provide you liquidity. So you own all your mistakes. I think that is the biggest challenge with bankers where the perception is if I make a mistake, I'll be able to sell it and there will be another buyer of it. In private credit land, that is not true. Ultimately, when you generate that return, it's going to be whatever your return is, less losses.
Doesn't mean you have to kind of stress test your employees against scenarios.
You have to make sure they understand the weight and make sure they have tension around every decision they make. Understand that ultimately the decisions they make have a direct impact on teachers, on firemen, on police officers, on savers. Those are ultimately our clients. And it's heavy.
That's it for this episode of The Next Big Risk. You could watch previous interviews on Bloomberg.com and on the Bloomberg Terminal. I'm Sonali Basak, and this is Bloomberg.